Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, Paris Rapeseed. We've had two patterns here, two completed patterns have been the main influence on this market since as far back as summer last year. This first pattern is an overextension of the bright red neckline, currently at 448 1 quarter, and that's of the May to August 2025 Head and Shoulders continuation pattern. The bright red neckline also shows up in the second pattern. In this case, it acts as a lower trend line together with the nearby green upper trend line that together formed a shallow July to October 2025 descending wedge pattern. We had a break higher over this pattern in October last year, a good break higher, or so it seemed at the time, but instead it turned out to be a false break higher, failing twice in late October and again in late November. And that's at the dark blue overhead neckline extension, currently at 484 even, of the August to September 2024 reverse head and shoulders bottom, and forming a small double top in the process. The downside primary and secondary targets for this small double top pattern were duly reached in December last year. However, prices overshot the targets on the downside, dropping down below the bright red neckline extension. But this neckline, along with the 50% absolute Fibonacci line at 445.5, eroded the bearish pressure, such that the very start of this year has been the lowest we have seen in this market since March 2024. We have since risen sharply, and this brings to mind the pattern the whole of November 2025 to date action has created, which is a diving board pattern where, from a fairly flat area, the market dives down as if into a swimming pool and then pulls up and climbs out of the pool. We have pulled up and climbed out of the pool and already reached the pullback target area, which is in the 72.5 area last week, as prices broke up over both the green short medium moving average, currently 467 3/4, and the mauve medium moving average, currently 469.5. The market halted for a while at the flatlining gold long moving average, currently 476 even. But this week has started to move higher. Now, I said last week, and I quote, a diving board pattern is a bullish reversal pattern, so the opportunity for higher prices is still there and something to watch out for. End of quote. The recent action also ties in with another feature I pointed out 6 weeks ago. I said, and it is a long one, a quote I'm afraid, and I quote, above the market we have a possible bow tie formation made up from three moving averages. They are the short moving average, currently 461 even, the green short medium moving average, and the mauve medium moving average. This possible bow tie formation happened this past Monday, the 15th of December, and is worth discussing. Thus, the theory indicates that after such a crossover, some 15 to 20 sessions after it, we have one or more of the following: a change in trend, a reinforcement of an existing trend, and volatility. This is complicated somewhat. We have a holiday period coming up, so it's not a straight 3 to 4 week run after. Instead, if we follow the count accurately, it will be between the 7th and the 14th of January 2026. End of quote. We had already had the big drop, and the move up started on the 5th of January, so close enough, and between the 7th and 14th of January we had a solid, if unspectacular, move higher, which verifies this pattern. The question now is what's next? Well, the overhead gold long moving average is being overcome, and then beyond that is the dark blue neckline extension. I would say they are both significant, if not formidable, with a more heavier emphasis on that dark blue neckline above. And looking below, well, we could try going lower again, but the market was down there recently and didn't like it. However, if we did try lower, the key will be the 50% absolute Fibonacci line. Winnipeg Canola. The key recent pattern here had been the fairly obvious late June to late October 2025 bear channel. 13 weeks ago, prices broke up over the upper bear channel line, as well as over the 2021 low at 629.5, plus the lesser Fibonacci line at 632.90, and then challenging and stabilizing over the green short medium moving average, currently at 636.90, before 10 weeks ago making a small gapping move higher, since filled in over the significant combination of the June 21 low at 655.90 and a 50% Fibonacci line for 2025 at 655.70. Now prices continued higher, but then, unsurprisingly, ran into trouble around the slowly declining mauve medium moving average, currently at 635.60, and the flatlining gold long moving average, currently 663.60. Further above is what may be in some ways the additional cause to this halt: the significant bright green April to August head and shoulders top neckline, currently at 686 even. Thus, we ended up and out of the bear channel, and we almost, though not quite, seemed to start to form a small October-based bull channel. However, the bullishness faded under the capping pressure of the mauve medium moving average and the gold long moving average, plus that 50% Fibonacci line for 2025 at 655.70. 8 weeks ago, prices turned lower for small November and early December based double top, with the market subsequently crashing down through all the previously mentioned levels. In the process, the primary target for the small double top at 641.40 was reached, as was the harder to reach secondary target down at 630 even. 7 weeks ago I asked, and I quote, whether this is a bearish half hesitation with potential down to even the 585 level. Thus, this would then be below the 50% absolute Fibonacci line at 606.90, and that would be one to watch. End of quote. And I added 6 weeks ago the following, and I quote, now in truth I favoured the basing action idea here, but it looks like the 50% absolute Fibonacci line is not going to stop the decline, in which case we would next be looking at congestion at 575. It all depends now on if the 606.90 up 50% absolute Fibonacci line can hold. End of quote. In truth, the 50% absolute Fibonacci line did not hold the market, but it did erode the bearishness enough that we formed a small double bottom pattern over the end of December last year and the start of January this year. The move up since the formation of that small double bottom has reached up to both the primary and secondary targets topside, and we have pushed up over the green short medium moving average and mauve medium moving average combination, and up to test the same resistances that capped prices in late November last year, and that's the 50% Fibonacci line of the 2025 move, which we have seemingly overcome, though not by far, and is as immediately above is the gold long moving average, which is currently at 663.60. Will the market this time push up through these? Well, I'm not too sure, as we have tried for about a week now with little success. However, beyond this, we would next have resistance up at the bright green neckline of the April to August 2025 head and shoulders top, which is currently at 686.10, though I'm still pondering how good any resistance up there might be. Bursa Malaysia crude palm oil. To start with, as I've done for most of last year, I'd recognise the wide congestion area that's overhead between 44.08 to 45.59. We tried in mid-October last year to pierce it and failed, with prices punching back down through the lower edge of this congestion as we exited October. On the way down, prices dropped down through another wide congestion band made up from the 38.2% Fibonacci line of the May 20 to March 22 move and the 50% Fibonacci line of the May 23 to December 24 move, both at the same 42.74 level. Then the 38.2% Fibonacci line of the July 19 to March 22 move at 42.39 and the July 23 high at 41.89 into a free area, where the market created a small diamond continuation pattern. Now, the recent overall pattern had been the mid-August to early October bearish Andrews pitchfork. This had been pretty good at leading prices lower until we reached three bands of congestion below. They are the lesser Fibonacci line at 40.26, congestion at 39.86, and the February 2011 high at 39.53. I suppose in the big picture you could also include the neckline extension to the late May to April 24 small reverse head and shoulders bottom, which is currently at well, it's down there at 38.30 area or thereabouts. I know the prior three eroded the bearishness of this market, so I suppose this one below may also have played a small role. Anyway, the move lower within the bearish Andrews pitch was fine until two things occurred. The first is the construction of what can be seen as a triple or even a quadruple bottom over the November 25 to January 25 period, though I have been inclined to look at it as a very, very complex reverse head and shoulders bottom. This is a subjective judgment on my part, and I realise that, but I take that on board. This pattern came from and after the previously mentioned November to early December diamond continuation pattern. The second occurrence happened last week, with prices breaking higher from this complex reverse head and shoulders bottom and punching up through the upper tine of the bearish Andrews pitchfork. The market's earlier actions precluded me finessing this to a shallower bearish shift pitchfork, so I'm downgraded the pitchfork this week, and I may likely retire it next week. Since that break higher, prices have overcome the previously mentioned overhead congestion band between 41.89 to 42.74, and over both the gold long moving average, which is currently at 41.52, and the mauve medium moving average, currently 41.94. This leads me to my final point, and when I first contemplated it, it was a difficult one. It was to discuss where the primary and secondary targets would be on the upside on the break above the complex reverse head and shoulders bottom. There is no easy neckline here, but as I said last week, and I quote, I feel it would be suitable to look at the 4100 area as a suitable point to start. Hence the primary target X would be up in the 42.47 area, so not too far above, with a harder to reach secondary target X1 up in the 43.07 area. I'm not wholly in love with either of these two, but for now they will do. End of quote. Well, since then, we have this week risen up and exceeded even, both the primary target X and the harder to reach secondary target X1. So where does that leave us? Well, we are in a pretty free area now, with space up to the congestion from September last year that starts at 43.50, but in truth really starts at the November 22 high at 44.08, and only really gets going between the December low at 44.67 and the June 22 low, December 21 low at 44.67 and the June 22 low at 45.59. So there is further room on the top side should the market choose to try to go higher. It will be interesting to see if it has the appetite to do that. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.